So you're thinking about buying your first real estate investment property in Canada, and you're wondering about how you should go about the current interest rate environment to make that decision as far as your mortgage is concerned. I'm gonna get right into that today. I'm not gonna waste any time, but more importantly, we're gonna talk about the impacts of your decision-making in any market climate, both fixed and variable, some key considerations, and what you actually need to look out for if you're buying your first investment property or anyone else. Picking a mortgage product when buying an investment property is probably one of the most under-considered factors of actually buying an investment property itself. Most people only look at what's the rate, what's the payment, and then they try and figure out what they can do with the investment property itself. But as it pertains to investing as a whole, if you're looking to build a portfolio, whether that be one property, two properties, three properties, or more, you need to be looking at the strategy around the product and the rate and look at the market climate, which is why you need a key advisor and not just looking at interest rate. We need to start off by building a base and understanding, objectively speaking, what is your goal with this property when you're trying to determine interest rates. Now, in the current market climate that we're in 2024, interest rates are relatively high compared to where they have been in the modern era, modern being the last 10 to 15 years. Over the last 10 years, we'd seen interest rates hover between 3 to 4%, and today we're seeing interest rates anywhere between 5.5 to 6.5%. Ultimately, that has an impact on your bottom line, your cash flow, the amount of money that you take. But as you know, investing in real estate isn't only about cash flow, although it is partially. It is also a consideration of equity growth, appreciation, and potential sweat equity that you're putting into the property to improve it or bring more value from rent on the actual property itself. When you're thinking about looking at mortgage rates and options as it pertains to your investment property, which you should be because you're borrowing money from a bank, even at today's interest rates, you should just be considering what's your plan. Now, the last couple of years, as we mentioned, has seen interest rates spike up, which has made people turn off or turn away from investment properties because they're just not cash flowing as much. But what that says to me is that you need to consider your plan or strategy. If this is your first investment property, a couple things you need to be thinking about. Number one, where are you getting the money or the down payment for this future property? Do you own a home today? Is there an option to use your home equity line of credit? Or should you refinance, which is to pull equity of your property? Now, that ultimately depends if you have a fixed rate or a variable rate on your current property, or if you have an option to add a home equity line of credit. But remember the magic rule. When it comes to qualifying for a monthly payment, the rule is that the lower the payment that you have on your other property or other mortgages, the more you can qualify for somewhere else. And one of the biggest mistakes that people make is instead of taking the longest amortization period, they take a short one because it's a slightly lower interest rate or because they don't want to pay as much interest. That's a mistake, because you qualify for less than you could have and you'll have less options as it pertains to lenders. So starting again, when you're trying to determine, should I go fixed, should I go variable, should I go short-term, should I go long-term, you need to consider a few different things. First and foremost, if you're buying your first investment property, this is your first one. So you need to have a combination of both flexibility and certainty. Let's assume you're buying this from a long-term rental perspective. Let's determine, are you actually purchasing this property and planning to do any renovations or improve the property value? Are you the type of person that's looking for something more conservative or something a little bit more risk averse? And think about your own personal situation. To put it lightly, if you're buying your first investment property, we hope that you're well capitalized or have good income or a good job, potentially have a large line of credit on your existing property, or you have good savings in purchasing this particular property, or you're doing this as a joint venture with someone else, so buying with another person to help you qualify and one of you or both of you are well capitalized. In these situations, you can have a little bit more risk and you have a little bit higher tolerance, but risk is a little bit subjective. Now, in a rate market like this today, we've seen many of our borrowers decide to go for something more on the higher interest side in shorter terms, even if the cash flow is negatively impacted because of the ability to see these potentially properties appreciate if rates go down. So to put that in more clear terms, if rates go down, house prices go up. So if you buy today at a higher interest rate, even on a shorter term, in 2 years perhaps, or 3 years, you could technically actually refinance that property to pull out any new equity from the growth and appreciation. And you could reduce your actual mortgage payment by having a lower interest rate. So for those who have a little bit more comfort, we'd suggest considering perhaps a shorter term, especially in the current rate environment. Some people are still asking about considering variable rates. Well, the most important consideration there is that you're starting high and hoping that rates will come down. Now, the math shows, as of today at least, that if rates were to come down 2.25% over the next couple of years, we would actually see that beat out the fixed rate strategy. The one negative being, of course, there are only a few lenders that will actually offer a declining payment or an adjustable rate mortgage. Most big banks offer what's called a fixed payment variable rate, or a VRM product. We do not recommend this product, especially in a declining rate environment, because this has a negative impact on your overall cash flow. The one positive of any variable rate mortgage is always the number one thing that people don't think about, and that's a topic that we're going to talk about next, which is specifically breakage fees. So everybody thinks about one thing when they're getting to the mortgage, what's the rate, but no one thinks about what's my cost, and that's the biggest mistake that people make, is they're only looking at the today's sense, they're not looking at down the road. If you're in a situation where you plan to sell the property or refinance because rates come down or anything like that, and you take on a fixed rate mortgage, the number one thing you need to ask your broker or your bank is, what is the cost of breaking that mortgage? If we were talking about the variable rate, they have that one key advantage, which is that the only cost to exit that mortgage is a 3-month interest penalty, as long as you don't take a restricted mortgage product. Whereas if you do take a fixed rate mortgage, there is a penalty called an interest rate differential. And in short, this penalty can cost you as much as 5 to 6% of your mortgage balance. Let's assume you're borrowing $400,000. That's $20,000 to $30,000 that you could be paying in mortgage fees and penalties just by sacrificing and taking the lower interest rate up front. So when you're picking your mortgage product, you need to consider a few things. Number 1, flexibility. Number 2, term length. Number 3, your plan. Are you going to be refinancing or restructuring? Number 4, what is your comfort? Are you more risk averse, more conservative, or are you someone who likes to obviously look at the market and take guesses based on where you think something could be going? All these things should be thrown in the pot and be used to help you make your decision, notwithstanding, as we mentioned, the prepayment penalties. Back to someone who's purchasing their first investment property today, a few things that you should be thinking about. Number 1, you need to be looking in areas, especially with so much change going on. If you're buying in Canada, you need to be looking at areas that have a large amount of potential growth. And that could be all over BC, especially with the new land use rules. But if you're looking in other parts of the country, you need to be looking in areas that have potential for growth, but maybe aren't there yet. So if you're buying brand new, you need to be looking in an area where maybe it's the first brand new building in that area and the rest of the buildings are going to be built up, so you can ride that appreciation growth over time. Number 2, you need to be looking in that location, in that neighborhood, to understand what are the types of stores, what are the things that are going on around there, because it will help you to determine the tenant profile and the type of person that you'll be renting out your property to. Number 3, you need to be deciding on your long-term plan. Is this a property that you plan to hold for 5, 7, or 10 years? Or are you the type of person that's going to be renovating this property and looking to cash out in a few years' time? All of these considerations need to be thought of up front before you're actually making your decision. What we recommend is a healthy combination between understanding your timeline, your plan, picking a location and product type, but determining an outcome based on the numbers. And the way that you can determine this is based on a pro forma. Now, if you're watching this video and you're looking for access to a pro forma, make sure to send me a message in the comments below, say pro forma, and I'll reply back to get your information to send you a copy that you can use to analyze on your own. Now, a good pro forma should help you to understand the outlook with potential appreciation, your total costs as it pertains to anything that could be included: insurance, hot water, if you're paying for internet, taxes, anything like that. And these should always try to be more on the conservative side as opposed to the aggressive side, because you always want to know your worst case scenario. In preparing your numbers, another factor that you need to be considering or thinking about is actually, what are my potential costs and having an emergency fund? Because having an emergency fund is going to be a huge consideration of buying your investment property. Now, timing of buying an investment property is absolutely massive. And in today's market right now, there are opportunities, but there are also huge potential mistakes you need to really watch out for. The one key advantage of buying in this real estate market is knowing that most of the economists and most of the bankers are coming out with reports on a daily basis suggesting that prices have hit or are pretty darn close to their bottom, and rent's still going up. So you have a key advantage right now that if you can acquire a piece of real estate, even at a higher interest rate, you could renegotiate the terms, ride the backs of real estate values going up, and more importantly, over the next few years, likely see rental rates go up. Ultimately, there's way more to buying an investment property than that, but some key pieces of information to help you make a decision on the mortgage rates were included in that video. Again, my name's Alex McFadyen. I'm the owner of Full Mortgage Co, and we help people make decisions like this all the time. So as I mentioned, if you're interested in getting a copy of that pro forma and working together, drop me a comment below, and I'll make sure to get that over to you.